So let's go ahead and talk about internal auditors for a second. Hold on. Sorry. So I worked at 7 years at Coca-Cola and 7 years at Philips Electronics. So I can tell you one thing, all soda related, Diet Coke, stuff like that, I am totally addicted to. So Diet Coke, Coke Zero, and basically anything diet, I can live with that. And my new favorite that has become bread and butter is now Diet A&W root beer. So apparently everybody tells me how bad sodas are. I get it, but they're the greatest things ever for me. Anyway, off to work. All right, we're going to talk about auditors right now. So as you become an accounting, as you become a finance professional, whatever it may be, you're going to deal with auditors. There are two types of auditors. You have internal and you have external auditors. Internal auditors are the auditors that want to keep you out of trouble. So they'll go through, they'll ask questions, they'll do deep dives into your data, they'll ask you for a lot of stuff, and you have a desire to tell them to, no, thank you. But keep in mind, these internal auditors are there to make your life easy and to keep you out of jail in some cases. You're going to have a lot of audit requests through your life. Right now, I'm going through an audit, and they've asked everything from tell me your account balances, basically they call it walk forwards. So walk forward the account balance as of December 31st, 2016 to current. Tell me what accounts happen, what transactions. Tell me basically give me a printout of everything that's inside your inventory by age. So basically it's age, slow moving inventory, right? So what they want to do, they want to see, here's my inventory, here's how much it's worth. When was the last time it moved? Because really what it comes down to, inventory, I think we've mentioned it before, inventory that doesn't really move, perfect theory, should be written off because it's obsolete, it's just not moving, you should write it off. They ask for that. They ask for a breakout of accounts receivable. Give me a listing of all your accounts receivable and age it. So same exercise. Tell me how much money people owe you and how long it's there. One thing I do want you to keep in mind when it comes to accounts receivable is that the longer a invoice is outstanding, the longer a bill or a payment has not been made, there's a lot bigger and bigger and bigger chance that the customer just won't pay it. It's a devil of life. If you can get somebody to pay a bill in 30 or 60 days, you're good. But once it's 90, once it's 120, the chance of you getting it is collected as a pain in the rump. But what a lot of companies do, they'll go through and it's called factoring of accounts receivable. With factoring of accounts receivable, as soon as you make a sale on account, which would be a debit AR, credit sell, right? You'll go to a local one of these factoring companies and you'll sell that AR to them for 99 cents on the dollar. They say, look, give me 90. It's the AR is $100. You pay me 99 bucks. I'll give you the AR and we're done. Now everybody wins in this case. You get 99% of your funds right off the bat. Life is easy. If that customer suddenly doesn't want to pay, it's not your problem anymore. It's the person who bought the AR. It's not your fault anymore. It's not your deal. But it also helps with the customers. When a customer come back and say, look, I'm having trouble paying for X, Y, and Z, your answer is like, look, I'm sorry, I appreciate that, but we sell our receivables to other people. So we have no control at all on that. So yes, you're not getting your full 100% of your accounts receivable, but factoring makes sense in a lot of cases. So if it's something that you're struggling with your accounts receivable on, definitely think about, wanting to factor it, sell it off. Now, for those brave souls who don't and who want to face the fight of collecting themselves, you need accounts receivable people. And they will call and they will call and they will call. And, then what will happen is that after you call for a period of time, you'll get somebody else to call. You have the ability, depending on what you've actually done for somebody, you can go through and do something called, you can issue a mechanics lien. And what a mechanics lien is, it's a lien that says, look, you perform services for this customer. They haven't paid you. You can really foreclose on their house. It is just a tactic of saying, look, I spent $10,000 remodeling your house. You didn't pay me. I'm going to foreclose on your house and sell it and all that. Most people won't let that happen, right? Most people will cough up the I don't know, whatever, $10,000 that they need or should be paying you. Quite frankly, they should have paid you in the first place. And they aren't doing that. They'll end up just paying it just to be done with it, which is what you don't care, right? It unfortunately does impact their credit, but at the same time, though, they should have paid you in the first place. The other part's going to be, if that doesn't work, we can take them to a collection company. Collection companies are, well, they're collection companies. I personally hate using collection companies because, I just don't like them at all. But still use them anyway because sometimes you can't get anything else. Then collection companies will call and say, look, we're going to put this on your credit report. We're going to do this. We're going to call. We're going to do all these X, Y, and Z. And most people will pay. Now, unfortunately, one reason I don't like collection agencies, I feel they're bullies, which don't like bullies. But the other part is they take 20% of your AR. 20%. It's a big, 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 big number. They take 20% just if they collect it. They don't collect it, they don't get anything, but neither do you, right? So I don't like that. So life is always easier when people will go through and actually pay their bills because you provided a good service. Now, one thing you'll deal with, though, is that, as we talked about these items, the auditors will ask that, you should always have a bad debt reserve. And what that simply means is that you're going back through, because you have a feeling, traditionally you'll know that 2 or 3% of your sales are eventually going to be lost, right? They're going to end up being converted to a bad debt. So the auditors want to have you maintain this 2 or 3%, just a balance inside of that to be able to help offset part of your open age AR. It's not unreasonable. It's actually, quite frankly, it's something you need to have. And you can calculate that number based upon, really look at your history. Did you have 2% of your total sales were lost? 3%, 5%? I would use a historical trend. If it had like 3%, 2 to 3% of total sales is a good general number to use. You can end up doing that. They'll ask for accounts payable. They want to see all the invoices. One trick that and especially when it comes to end of the year, what will happen is that companies will, accidentally or not, they will not record all their expenses in the month of December because they want to hit certain profitability targets. And if they don't record an expense, well, then during December, and even though it's recorded in December, well, it's not there. So what will happen is, one, the auditors will ask to see all your expenses, the setting inside of accounts payable, totally fine. But they'll ask for a cash disbursement journal. And what that means is they want to see all the cash that you pay out from January 1, like we'll call it 2017, all the way up till they finish their audit engagement. Because they're clever, right? And what they're going to know, they're going to say, hey, what they're doing is they're not going to have all these expenses accrued, not going to have them in. So they're going to receive the expense. They're going to take the expense in 2018, pay for it in 2018, even though it belongs in 2017. People are clever that way, right? And they're able to catch that by looking at this little cash disbursement journal. Because what it'll show is like, hey, here's the invoice number, show the invoice number, and they'll say, look, I want to see every one of the invoices that you pay on this cash disbursement journal. And you'll say, okay, because you have no other choice but to give the auditors what they want to. Keep in mind, you have no choice, you have to do it. Unless you're willing to do, just really ruin your company, anything they ask for, and it's doable, you need to give it to them, right? And they're able to identify that and like, no, you can't do that. It doesn't belong in 2018. You need to reopen your books for 2017 and then rebook these expenses. And it happens a lot. If it ever happens to you, don't worry about it. It is not unusual for hundreds of thousands of dollars to be booked into a prior period, to a prior year. It's not unusual. So if it ever does happen to you or your company, don't freak out about it. It's kind of normal because everybody plays the same game. Just don't worry about it too much. But they'll put the charge back in 2017 where it belongs, and they're going to keep very close to that. What the auditors also do, we talked about inventory before, everything is in a storage location, pallet position, whatever you want to call it. So they'll go out, they have their count sheets, they'll go out to this location, and the auditors by themselves or with a finance person hanging on. The rest of them will count. 1, 2, 3, 4, 5, 6, 7. Hey, there's 7 there, and I counted 7. Life's good. Now, when there's variances, what will happen is that auditors will either do 2 things. The first thing they normally do, they'll continue to count, even though their original selection may have been only 10 items, they're going to probably count 20 or 30. They're going to keep counting as long as they find variances. And then what's going to happen, the variances they have, they're going to do the worst thing in the world. They're going to do something called, they're going to extrapolate. They're going to go back through and calculate how much the value is, how much your loss is, how much inventory you're missing. We never like them doing calculations because calculations, when auditors do them, is always a lot bigger number than we'd want. So our inventory should always be good because we're professionals, right? We want inventory to be good. But you have to support when your auditors ask for stuff. Your answer is yes, I'm happy to get it for you. You can push them off for a little while, but you can't push them off forever. But big story is whatever auditors ask for, do it. Your big thing is that they're smart, they're clever. Don't try to hide numbers. Don't try to bury stuff in the balance sheet. Because we mentioned before, right? People would traditionally love to bury expenses in the balance sheet because, well, it's a balance sheet and you stick things on there. You're not supposed to, right? The only time it should be on the balance sheet is if it has a life which will exceed 2 months. At that point in time, over 2 months, you can put it on the balance sheet, but you have to write off every month, write a part of it off every month. Some people will stick everything there. They make their P&L look great, but the reason is they put all their expense on their balance sheet. And, their balance sheet's just totally fraudulent, right? It's just totally messed up. It's not real. It's not realistic. But their P&L looks good, But as for finance people, we, as we audit, as we do these things, we take a balance sheet approach. And what that means, if our balance sheet is right, if our balance sheet is true, if our balance sheet doesn't have a lot of mess hung up inside of it, then we can trust the calculations from our income statement. But the balance sheet has to be right before we even think about touching our income statement, because people hang stuff up on the balance sheet because it's a way to get around numbers. I mean, and we're accounting people. We think in terms of gray sometimes, so that's what they pay us for. But anyway, but it's fun, right? I love accounting. It's thinking, it's evolving, it's really analyzing. But you'll deal a lot with auditors, internal, external. Internal auditors will ask you the same. Internal auditors will ask you the same questions. External auditors, except that you still have to support them too. External auditors, you don't want to mess with them because, well, they sometimes people lose their jobs if they lie to external auditors. So you never do that. But just support them, right? They're looking for certain things, right? The only thing auditors are really doing, auditors have no value at all to a company. No value at all. All they're doing, they're asserting that your financial statements are prepared in accordance with generally accepted accounting principles, and that there are not, to their ability, because they just test, there are no material misstatements because they tested on that sample. Now, that doesn't mean stuff can be in the wrong place, right? Maybe something that should be a wage expense and you've recorded it down here as selling expense. They don't really care about that. They're looking for big dollars. They're looking for the big stuff that happens. So you got to support your auditor friends. Anyway, all right. Hope you enjoyed. See you soon.